Step 8, calculation of goodwill or capital reserve. Calculation of goodwill or capital reserve. See, purchase consideration paid, to subsidiary company on acquisition date, PC paid to subsidiary and investment amount S1 by PC to subsidiary company 1 for the investment amount in S1 by a parent company. Next, PC to S2, shares of the parent company in S1. The investment amount S2, investment amount in S2 into share percentage of the parent company into S1. That's called 48 percentage. I have 80 percentage in my subsidiary. My subsidiary have 60 percentage over there. 80 into 60, that is equal to 48% controlling in the S2. Now, add back non-controlling interest on acquisition date less net assets taken over by the subsidiary net assets taken over subsidiary company and acquisition date. Step 6. Then either goodwill or capital reserve I'll get it. Now, consolidated calculation of consolidated other equity. Final balance on consolidation date. Calculation of consolidated other equity, final balance on consolidation date, particulars, retained earnings, general reserve, other reserve total. Parent company own reserve balance as on consolidation date plus share of the parent in post acquisition reserves plus share of parent company in post acquisition reserves of the subsidiary minus share of the parent company in dividend paid by a subsidiary company minus share of the parent company in impairment of the goodwill if any minus unrealized gain on inventory or property plant and equipment in downstream transaction if any minus additional depreciation and unrealized gain portion of the PPE in any upstream transaction from the subsidiary company to parent if any, plus or minus any other adjustment in specified above. Just 1 minute. అమ్మ, జుట్టు మొత్తం పోయింది దేవుడా. అమ్మ జీవితం, దేవుడా సక్సెస్ ఎప్పుడు వచ్చిందా కానీ సగం జీవితం సంకన అయిపోయింది. Calculation of the consolidated other equity. Calculation of consolidated other equity final balance on consolidation date. Particulars, retained earnings, general reserve, other reserve total. Parent company own reserves balances as on consolidation date. Add share of the parent in post acquisition reserves of the subsidiary. Add share of the parent in post acquisition reserves of the subsidiary minus share of the parent company in dividend paid by a subsidiary company. Share of parent company in dividend paid by a subsidiary company minus share of the parent company in impairment of the goodwill if any minus unrealized gain on inventory, property, plant and equipment in downstream transaction if any. Add additional depreciation on unrealized gain portion of the property, plant and equipment in upstream transaction from subsidiary company to parent company if any, plus or minus any other adjustment if any specified given in question. So all these adjustments to be done, then you will arrive, the figure is called consolidated other equity in the final balance on consolidation date. This is you go and put there. Now, question number 10. Preparation of the consolidated balance sheet, same as discussed in the step number 10 about topic. See, we need to understand like this. First, the parent company reserves and balances as on consolidation date. Okay, fine. Share of the parent in post acquisition reserves of the subsidiary company. That's true. Share, but deduct share of the parent company dividend paid by a subsidiary company. Why this came? We already discussed regarding dividend part, how to take the dividend. The acquisition is the beginning of the year, the acquisition in the middle of the year. The acquisition beginning of the year considered the dividend is paid out of what? What I mentioned previously. We discussed a lot about the dividend. We also written in the notebook about the dividend. Let's go and open. Dividend part, we already clearly discussed a lot regarding to dividend. What we said dividend part? Dividend should be added back to the profit. I need to add to pre-acquisition profit or post-acquisition profit. In this concern, we already talked a lot. We are already talked a lot on the dividend part alone. See, the dividend is paid before acquisition, after acquisition. Before, add to the post profit. After, add to the pre-acquisition profits. It means what? If subsidiary company acquired on or before the beginning of the year, current year, then dividend paid by a subsidiary company in the current year is added to the post acquisition of the retained earnings of the subsidiary company. Dear friends, the people's advocate Sreemannarayana.Mallela speaking on the matter of the dividend during the consolidation. What is said? The date of acquisition, beginning of the year, middle of the year. If beginning of the year was acquired, then the dividend is surely paid out of the current year profit. So I need to add back dividend to the post acquisition profit. It is a simple logical technical issue. Why I came today as on 1/4/2025, but the dividend was issued absolutely either May, June, July, August, something. Surely it was out of the post acquisition. So, what I need to do, I need to add back to the post acquisition profit. Then, what will happen? The moment I add back to the post acquisition profit, whatever earnings available, the post acquisition, as a parent, I also have a share. My subsidiary also have a share. During the computation of the other equity, my share, my share of dividend or impairment, I need to reduce in order to arrive correct other equity. That's the reason it happened. So the blindly remember thing is, if dividend is, if acquisition happen beginning of the year, then whatever the dividend is, add back to the post acquisition. Whereas acquisition happen in the middle of the year, then dividend is out of the pre-acquisition profits. And then whatever post-acquisition, pre-acquisition will be decided on time ratio. That's what. That's what I want to talk. Let's go back to our discussion at the end of the part of India's 110. Once this complete 110, we are going to step in 109. Very, 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 very important standard. So it give you boost. It give you energy. It give you like honey while eating of that standard. Eat that standard, get the energy, boost the exam, kick the exam. Okay, let's go back. to discuss. Let's go back to our normal discussion. Our discussion is at the end of here. So of the dividend paid by a subsidiary company, the share of the parent I need to reduce, as well as the impairment of the goodwill, the parent portion I need to reduce, as well as unrealized gain on inventory or property, plant and equipment, parent share I need to reduce, and additional depreciation on unrealized gain, the portion of the property, plant and equipment in upstream transaction from subsidiary company to parents, if any. If downstream transaction, that profit element underlying in the reserves and surplus of subsidiary company. Whereas upstream transaction, the profit element of the subsidiary company will be laying in the balance of retained earnings of the parent company. So that I need to bring down in case of any additional depreciation on unrealized gain portion of the property, plant and equipment, an upstream transaction from a subsidiary to parent company, if any, I need to add back. Any other adjustment, if any specifically given, we need to adjust here. Then you will arrive consolidated other equity. If you correctly report this figure, your entire balance sheet will tally. Otherwise, you will arrive to differences. Okay. Now, preparation of the consolidated balance sheet, same as discussed in the step 10 of the above topic, which already we discussed in previous class. Now, the purchase of stake in subsidiary company after acquisition to control by a parent company. Purchase of additional shares in subsidiary company after acquisition of control of the parent company. Journal entries in single financial statement for a parent company for acquisition of in additional stake in subsidiary company, investment in subsidiary company account debtor to cash or bank account debtor, investment in subsidiary company account debtor to cash or bank, the accounting in consolidated financial statement by a parent company for acquisition of additional stake in subsidiary company. Amount paid to acquire additional stake in subsidiary company. Now, amount paid to acquire additional stake in subsidiary company. Accounting in consolidated financial statements by a parent company for acquisition of additional stake in subsidiary company, share of non-controlling interest will decrease, and hence we have to reduce non-controlling interest to the extent of additional stake purchased by a parent company. Understand? What I want to tell you, amount paid to acquire additional stake in subsidiary company, for that journal entry, investment in subsidiary company account data to cash or bank account. Cash or bank account. Accounting in consolidated financial statement by a parent company for acquisition of additional stake for acquisition of additional stake in subsidiary company. Share of non-controlling interest will decreased, and hence we have to reduce non-controlling interest to the extent of additional stake purchased by a parent company. Share of the non-controlling interest, share of non-controlling interest will decrease, hence we have to reduce the non-controlling interest to the extent of the additional stake purchased by parent company. That's the important journal entry in the consolidated financial statement. Non-controlling interest account debtor for Y, the proportionate carrying amount of the non-controlling interest. Loss or acquisition of additional stake in subsidiary consolidated other equity account debtor. That's called the balancing figure. To cash or bank account to gain on acquisition of additional stake consolidated other equity. The amount account debtor to cash and bank account to gain on additional stake in the consolidated to gain on acquisition of additional stake in subsidiary consolidated other equity. That's called balancing figure. Consolidated other equity means group retained earnings. Example 1/4/2022, A Limited acquired 70% stake in B Limited. On 31/3/2024, A Limited acquired another 20% stake in B Limited by paying a cash of 2,600. The carrying amount of the non-controlling interest 30% on the date, on this date 6,600. Now, the solution for this journal entry in consolidated financial statement, non-controlling interest account debtor 6,600 divided by 30 into 10 percentage. That's account. See, 6,600 for what? 30% stake. Then 10% stake he got again. No. For that account debtor. That's how much is coming? 2,400, 2,200, 6,600 into 10 divided by 30. That is equal 2,200. Now, other equity account debtor. Other equity account. The loss brought forward, which is the supposed to be the value is around 2,600, but whereas I got for 2,200 only, then what about the other equity loss? That will be the balancing figure. To cash account debtor 2,600. I paid 2,600, but whereas the value is 2,200, the balancing figure of the other equity loss brought forward 400. Now, now, my dear friend, sale of sale of stake in subsidiary company by a parent company. See, sale of stake in subsidiary company by a parent company. This may also happen. The journal entry in the single financial statement. Standalone, not single, standalone financial statement. By a parent company for the sale, see, journal entry in standalone financial statement by a parent company for sale of stake in subsidiary company. Cash or bank account debtor, amount received on sale of stock. Cash or bank account debtor, amount received on sale of stock, sale of stake. Cash or bank account debtor, amount received on sale of stake. Loss on sale of stake in subsidiary company, P&L account debtor, balancing figure. Loss on sale of stake in subsidiary company, P&L account debtor, brought forward. To investment, to investment in subsidiary company account debtor, the proportionate carrying amount of the investment. To gain on sale of stake in subsidiary company, P&L account. Cash or bank account debtor, amount received on sale of stake. Loss on sale of stake in subsidiary company, P&L account debtor. దేవుడా మన జీవితాలు ఎప్పుడు మారుతాయో సీఎఫ్ అని ఎప్పుడైతే కానీ దేవుడా లైఫ్ ఖతం అయిపోతుంది మా జీవితం. సరే ఓకే 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 టార్గెట్ FR 60, AFM 60, దెన్ ఆడిటింగ్ 40. సిఎఫ్ఐఎల్ సెకండ్ గ్రూప్లో DT 60, IDT 60, IBS 40. దట్ ఇస్ ద టార్గెట్. ఎందుకంటే దేర్ ఆర్ కోర్ పేపర్స్. FR is a core paper. AFM is a core paper. If you are not able to get 60 marks in the core paper, what is the hell preparation is going on? What is the hell is doing our business? What is the hell is the life? If you are not get 60 marks in the core paper, then what kind of studies we did? That's bad. So we will get 60. But our preparation should be in the 90% level, not 60% level. If you prepare 100%, cut to copy paste AFM, cut to copy paste FR, you will get 60-60. Life will change at all. No more worries. Life. We are preparing now. We'll challenge the exam. No problem. Prepare, prepare, prepare. Blast. Cut to copy paste in exam. That's it. Whatever you give. That kind of knowledge and understanding the subject, surely will get good marks, no more doubt into that. See, sale of stake in subsidiary company by a parent company, journal entry in standalone financial statement by a parent company for sale of stake in subsidiary company, cash or bank account data for why amount received on sale of stake. If the difference between the value you received and paid, that will be loss on sale of stake of the subsidiary, which is going to be charged to P&L account debtor, the balancing figure. 2. Investment in subsidiary company, proportionate carrying amount of the investment in the subsidiary. 2. Gain on sale of stake in subsidiary company charged to P&L. Either you may loss, either you may gain. On sale of subsidiary investments. Now, the accounting in consolidated financial statement by a parent company for sale of stake in the subsidiary company. If sale of stake results in no loss of control in subsidiary company, journal entry, cash or bank account debtor, the amount received on sale of stake, loss on sale of stake in subsidiary company, account debtor, to non-controlling interest. See, cash or bank, we are going to receive an amount received on the sale of stock, stake, that account debtor, loss on sale of stake in a subsidiary company, consolidated other equity, which is charged to consolidated other equity, which loss on the sale of stake, that's the balancing figure. Now, to non-controlling interest. The carrying amount of the net asset subsidiary company goodwill and sale of debt into percentage of stake sold by a parent company. Understood? Not understood. Let's. Carrying amount, net assets of the subsidiary company and goodwill on sale of debt into percentage of stake sold by a parent company. The balancing figure. For example, I have a non-controlling interest is 30 percentage, but the net assets of the subsidiary company as on the date of acquisition, later on stake sale, what percentage into that percentage, carrying amount of assets of the net assets of the subsidiary company including goodwill and sale debt into percentage of stake sold by a parent of company. That's two non-controlling interest account amount, net assets, subsidiary company, including goodwill, on consolidation date or maybe the on sale date, into percentage stake sold by a parent company that you charge it to non-controlling interest. Then your non-controlling interest portion will be increased. Why? Earlier 30 percentage. Later he sold the stake. That stake is going to add to non-controlling interest. That's why cash or bank account data, loss on sale of stake in subsidiary company account data to non-controlling interest. That is the journal entry. Why? Earlier 30, now it is 25 only because 5% was introduced to non NCI. Okay, am I right? Yes. Now, in case profit to gain on sale of stake in subsidiary, consolidated other equity. Consolidated other equity means group retained earning. See, for example, let's see one example. A Limited purchased 80% stake in B Limited in 2021 for 1040 rupees. On 1/4/2023, A Limited sell stock in B Limited for 500. A Limited sell 25% stake in B Limited for 500. Carrying amount carrying amount of net assets carrying amount of net assets of subsidiary is 1300. Okay, now goodwill is 200 on the date of acquisition. Now the solution here, A Limited sold 25% stake in B Limited. Thereafter, in the stake in B Limited will be 80 percentage minus 25. How much will be? See, I acquired 80 percentage, right? Then non-controlling interest will be 20 percentage, right? Later on, I sold 25 percentage again. Then out of my 80, I reduced 25. Then what is my controlling? My controlling is 55 only. Hence, there is no loss of control for the A Limited in the B Limited. So journal entries for the stake sale like below. How the entries? In standalone financial statements, cash or bank account data 500. Why? I sold 25% stake for 500 rupees, 500 crores only. And to investments in B Limited. My investments in B Limited, how much? 1040 rupees. For 1040 rupees is for 80% stake. Now I reduced to 25% stake. Then what happened? Let's take the calculator. 1040, I have investments and the date of acquisition, and thereafter I sold 25% stake. Yes. Then what happened? Sorry. 1040 divided by 80 into 25. So 1040 is the value for 80. Then what about the 25 percentage? That will be around 325 lakhs. I am receiving 500 lakhs, but my value is 325 lakhs, and the balancing figure is gain on the sale stake subsidiary. That's called around 175 lakhs. So this is the entry for stake sale. Later on, in consolidated financial statement, cash account data are 500. Non-controlling interest. How to compute non-controlling interest? Let us understand. The carrying amount of the net assets of the subsidiary including goodwill, what I spoke the beginning of the year, I said the carrying amount of net assets of the subsidiary at the time of the stake sale was 1300 and goodwill is 200. Now together how much? 1500. This 1500, out of this 1500, what I am going to do? I am going to sell 25% stake. 1300 plus 25 into, sorry, 1300 plus 200 into 25 percentage. This 375 I will be charged to non-controlling interest, and gain on sale of the stake sale, the it goes to consolidated other equity. That's 375 minus 500, that is equal to 125. This 125 goes to, this 125 goes to retained earnings. That's called the journal entry. See, sometimes what happened during the course of these transactions, I may lose the control also happen. Sometimes, if the lost control in the subsidiary company, what to do? That's what we are going to discuss now. That's what we are going to discuss now at last. See, if I lose the control in my subsidiary, recognize the amount received for sales stake in subsidiary, that cash or bank, de-recognize the carrying amount of the net assets of the subsidiary, goodwill on sale date. De-recognize the carrying amount of the net assets of the subsidiary and goodwill on sale date. Since you take the sale, you please de-recognize in your standalone financial statements regarding to subsidiary company, because you didn't stake sale. You no more longer you will be as investment in your investments in your balance sheet regarding to subsidiary company investments. And de-recognize the carrying amount of the non-controlling interest on the sale date. Since stake sale happen, suppose in my consolidated balance sheet, if I'm maintaining the non-controlling interest, I need to de-recognize the stake sale happened to the tax rate percentage. It will be given in the question, otherwise calculated regarding to de-recognize percentage. If non-controlling interest as per profit sharing net assets method, the carrying amount of the net assets of the subsidiary company on the balance sheet date into share of the non-controlling interest percentage before stake. If non-controlling interest is as per the profit sharing net assets method, carrying amount of net assets of subsidiary company on sale date into share of share of non-controlling interest percentage below sales stake. See, to talk about subject is a energy. To understand about the subject is an energy. To talk about new things is an energy. Knowledge is an energy. The moment you are getting the knowledge, it's one kind of energy will transform your body the moment you deliver. That's true. See, a knowledge is a power. Not only power, it is an energy. The things which innovative things, the moment you are speaking, it will transform to audience and listener as well as a spoken by you is a knowledge transformation, is kind of energy transformation. That's why this kind of impression, that's why this kind of style of talking. Why? The knowledge, energy could not be silent while talking the innovative things, knowledge things. The expression will be like this. Why? The knowledge convert into energy and transform into behavioral aspects of life. I believe it. Of course, someone already everything knows. They don't feel this kind of expression or this kind of behavioral theory. But for me, the moment I gain the knowledge, sharing the knowledge, my behavior is like this. What can I do? So, okay. Now, what I'm talking, that de-recognize the carrying amount of the non-controlling interest on the sale day, it will be given in question, okay. Otherwise, you compute. Now, if non-controlling interest at fair value, carrying amount of the net assets on carrying amount of the net assets of the subsidiary company and goodwill on sale date into share of the non-controlling interest percentage before the sales date. Understood? If if non-controlling interest at fair value, then carrying amount of net assets of the subsidiary company and goodwill on sale date into share of the non-controlling interest percentage before sale of stake. De-recognize the carrying amount of the NCI and sale date. So that's need to do. Recognize recognize stake recognize stake retained, if any, in subsidiary company by a parent company as investment at fair value. యమ్మ జీవితం సగం చుట్టుకుపోయింది దేవుడా. సరే, ఓకే. ప్లీజ్ కాన్సంట్రేట్. Recognize stake retained, if any, in subsidiary company by a parent company as investment at fair value. Recognize stake retained, if any, in subsidiary company by a parent company as investment at fair value date. Fair value. So fair value of investment retained will be given in question. Otherwise, calculate it carrying amount of the net assets of the subsidiary company, carrying amount of the net assets of the subsidiary company, and goodwill on sale date into percentage stake in retained by a parent company in subsidiary company. Fair value of investment retained will be given in question. Otherwise, calculated carrying amount of the net assets of the subsidiary company, including goodwill and sale date, into percentage of stake retained by a parent company in subsidiary company. Now, difference in all these four items in journal entry will be recognized in P&L account as a gain or loss on sale of stake in the subsidiary company. That will be the balancing figure. Now, what's the journal entry? The journal entry, cash or bank account for amount received, non-controlling interest, carrying amount, investment account, retained portion if any, that's called fair value, loss on sale of the stake in subsidiary company P&L account, broad balance figure. Two, net assets. Two, net assets of the subsidiary company carrying amount. Two, goodwill carrying amount. Two, gain on sale of subsidiary company, which is goes to P&L account, is the balance figure. This is what example. A Limited purchased 80% share in B Limited in 2021. Example, A Limited purchased 80% stake in B Limited. A Limited purchased 80% stake in B Limited in 2021 for 1040 non-controlling interest as per profit sharing net assets on 1/4/2023. A Limited sells 35% stake in B Limited for 600 lakhs. Carrying amount of the net assets of the subsidiary is 1300. Goodwill is also 200. On this date, solution. A Limited sold 35% stake in B Limited, right? Thereafter, stake in B Limited will be 85 minus 35, that is equal to 45. Now, I lost the control, right? Journal entry for the sale of stake in standalone financial statement. Cash or bank account debt are 600. To investment in B Limited 455. How? 1040 divided by 80 into 35 percentage, that is equal to 455. Now, gain on sale of stake. Gain on sale of stake 145. Gain on sale of stock is 145. How can 600 minus 455, that is equal to 145 is the gain that's charged to balance sheet figure. Now, in consolidated financial statement, how it will be appear? Cash or bank account debt are 600. Non-controlling interest in consolidated financial, I'm talking about consolidated financial statement. In consolidated financial statement, in consolidated financial statement, cash or bank account debt are 600. Non-controlling interest portion 1300 into 20 percentage 260, and investments retained portion 1300 plus 200 goodwill, including goodwill, into 45 percentage, that's called 675. Why 45? Out of 80 I sold 35. 85 minus 35, sorry, out of 80, 35 sold, then 45% only I will have as a controlling. So that investment account I need to bring to 45 level. To net assets of the subsidiary company 1300, goodwill 200, gain and sale of the plant and gain and sale of the stake, profit and loss account 35. So this is the consolidated financial statement. See, cash 600 and non-controlling interest I need to add, right, in my consolidated. Yes, I took 1300 into 20%. And investments retained portion out of 80 percentage I sold 35. Am I right? Now that investments also I could bring down to the 45% level. Because stake sale happened. Previously I have 1500 investments. Now I need to bring to 45% level. Yes. Then net assets of the all subsidiary company. Net assets of the subsidiary company to goodwill account. To gain on sale of gain gain on sale of stake P&L balance sheet figure. Yes. So that's called consolidated financial statement entry. Now, notes. Now, notes. See, dear friend, deemed loss control in subsidiary company. It could happen when subsidiary company further issue equity shares to non-controlling interest shareholder. The same as accounting will be done on the sale of stake in the subsidiary company, except no amount consideration is received by a parent company in this case. Deemed loss of control in subsidiary company, it could happen when subsidiary company further issue equity shares to non-controlling interest shareholder. Same accounting will be done of the sale of the stake in the subsidiary company, except no amount consideration is received by a parent company in this case. Example, see example, current shareholding on 1/4 2022 of B Limited number of shares percentage. Shares held by a parent company 30,000, controlling is 60%. Shares of the non-controlling interest is 40%. Number of shares is 20,000. Total will be 50,000. On 1/4 2025, B Limited further issue 25,000 shares to non-controlling interest shareholder at the rate of 10 rupees per share. Now, shares by A Limited 30,000 shares still there. But whereas non-controlling interest increased 20 plus 25, then 45. Then total shares will be 75,000. Then NCA holding will be 60%. So this is the one chance to lose the control. Now, hence, A Limited loses control over the B Limited on 1/4/2025, as its stakes remain only 40% in B Limited. The parent company may lose the control in the subsidiary by sale of stake in two or more transactions on different dates. In this case, parent company can account for sale stake a single transaction of these transactions are dependent on each other as per India AS 110. A Limited has 80% stake in B Limited, which it disposed of following two transactions. On 1/4/2024 sale, 25% stake for 2.5 lakhs. On 30th April 2024 sale of 55% stake for 5.5 lakhs. Along for sale of stake will be done by assuming these as a single sale, single transaction. In case loss of control in subsidiary company by a parent company is also required to reclassify its shares in other comprehensive income, reserves of subsidiary company by transferring to P&L or retained earning according to the nature of other comprehensive income. See, In case in case of loss of control in subsidiary company, parent company is also required to reclassify its shares in other comprehensive income reserves of the subsidiary company by transferring to P&L or retained earnings according to the nature of the other comprehensive income reserves. How? How means share in revaluation reserve PPE of subsidiary transferred to retained earnings. Share of the FCTR of subsidiary fair value forex share in FCTR of subsidiary transferred to P&L account. Share in fair value of reserves relating to debt investment, fair value through other comprehensive income, subsidiary company transferred to P&L account. Share in fair value through FCTR of the subsidiary transferred to P&L account. Share in fair value reserves relating to equity investment, fair value through other comprehensive income of subsidiary transferred to retained earnings. Share in actual gain or loss subsidiary. Share in actual gain or loss in subsidiary transferred to retained earnings. See, accounting for change in investment in entity status. See, what happened? The moment I lose the control, previously I have a consolidated balance sheet and then I recognized as an investment. Now what happened? I lose the control. While preparing my balance sheet, the investments also I need to reclassify. Then I need to show my investments at fair value because of India's 109 and 113. Because of that, any unrealized gain, there are two kind of routes. One is fair value through profit and loss account. Another one is fair value through other comprehensive income. What will happen? The fair value through other comprehensive income directly goes to retained earnings rather than goes to P&L account. Whereas fair value through profit and loss account later on goes to retained earnings. So depend upon, since I lose the control, then I need to reclassify what kind of investment. That's equity instrument or financial instrument. If it is equity instrument, one kind of entry for the notional gain, anything is there. That how I need to recognize, depend upon the instrument. So one kind of entry was like other comprehensive income that routed through OCI routed through retained earnings. Other is routed through fair value through profit and loss account and again and then retained earnings. So this is what I need to do. That's why in case of loss of control in subsidiary company, the parent company is also required to reclassify its shares in other comprehensive income and reserves of the subsidiary company by transferring to the profit and loss account or retained earnings according to the nature of the OCI reserve. The OCI reserve, what kind of OCI reserve I'm maintaining? Then I do the accounting. Understood that? Not understood that? Let me see. See, in case of loss of control in subsidiary company, parent company is also required to reclassify its share in OCI reserves of the subsidiary company by transferring to the profit and loss account or retained earnings according to the nature of the OCI reserve. Example, shares in revaluation reserve, property, plant and equipment of the subsidiary company, that which goes to transfer to the retained earnings. Share in FCTR forex currency rate, maybe different rate. FCTR subsidiary company transfer to P&L account. Share in the fair value of the relating to debt investment, fair value through other comprehensive income of the subsidiary company transfer to profit and loss account. Share in fair value of the reserve relating to equity investment of fair value through other comprehensive income of subsidiary company transferred to retained earning. Share in actuarial gain or loss of subsidiary company transferred to retained earning. Share in actuarial gain or loss subsidiary company transferred to retained earning. And the end. Take break 5 minutes. I have one more. Some theory part is there. I'll talk and then I'll close the 110 and then we'll move to 109 today itself. Now time is 7:58.